G'day expats, welcome to another episode of Expat Chat, episode 47 today. And as always, joined by my friend, work colleague, business partner, Brett Evans, who is the Managing Director for the EMEA region. How are you going, Brett? How's the sandpit treating you today, mate?
Dust storms. Everything's got a taste of dust in it. We've had massive dust storms over the last 2 weeks and just
Yep.
everything is just, gritty. So
Now, is it because you're going into the hotter season now? Do you get more, do you think?
nah, look, these are rare. I mean, these things are coming from Iran and Iraq and these are monster. It's covered, Qatar, Kuwait, Bahrain,
Shit.
they've been massive. And then we had one the other day and they're not, normally when we get a dust storm, it's like an afternoon storm, that rolls through in Oz on the East Coast in the afternoon. It's like a cumulonimbus storm, but it's dust. These are just monster, almost like sort of the weather you went through in Queensland where you get that sopped in sort of rain. This is sopped in dust. It's been pretty average. And also it'd be rude of me not to introduce you, mate. So to the folks out there, joined by my mate, mentor, colleague, Muse, Mr. James Ridley, who's the Managing Director for the Asia Pacific region.
Thank you, mate. Listen, speaking of weather, we're obviously lucky enough to be based on the Gold Coast, and I'll tell you what, we've had the worst string of just wet weather probably the last 3 months. And I think when you, even in the office, when I'm looking at everyone else in the office, we're all quite pasty compared to the usual maybe year-round 10 that we're lucky enough to have because we're obviously based in the Gold Coast.
Stuck inside.
Yeah, mate, we're all looking a bit whiter than usual. I think we're all craving a bit of vitamin D. But yes, there's a sign of relief. We've got the sun out today, which is nice. But I think we've actually had about 60, maybe 65 days of just consecutive rain where it's just been wet weather or overcast and a bit miserable. I feel like might be in the UK, to be honest. But
it's a lot of water.
Yeah, it is. But man, I want to jump into today's episode, and it's obviously it's been a quick hot minute. We've got a new government. Obviously Labor's in now, and then
no surprises there.
No, you're right. No surprises. And then I was just watching on the national press conference. They're talking about how Dutton's going to be the new leader of Liberals, which I think will shit a lot of people. To be honest, he doesn't have a lot of favourites. So Liberals, I think, are going to go downhill from here, to be honest. But now that Labor's in, wanted to discuss, what and if it means anything for expats. Okay, new government's in. What's always been their viewpoint or perspective on expats, Aussie expats, and then wanted to wind up today's episode with a bit of Q&A. Some questions have come in.
Sounds good, mate. And let's get the disclaimer out of the way. All the information that we are about to preach to you guys and girls out there should be treated as informational purposes only. It should not be construed as personal advice. Please speak to a professional like Atlas.
That's right, mate. Now, Labor, I suppose in the past, they've had some very unique, put forwards when it came to tax, capital gains tax, negative gearing, franking credit refunds. I think they had probably 5 or 6 of the worst tax policies we'd all ever heard of when it came to just overall wealth. And that's probably why they got shut down last election, to be honest. This time they've gotten rid of all those old policies. They're trying to be accommodative within means. What's your perspective, firstly, of Labor and probably the proposed residency rules? That they did. I think we've both realised that they were both quite supportive of them, weren't they?
They were, and I think we're in this sort of strange world at the moment is the Lib's more left-leaning and Labor's more right-leaning. And there's actually very much an opaqueness or greyness between the two, emerging of the two. So I don't think Labor coming in is as big a shock as it was in the past. In the past, if you go back to the days of, obviously Bill Shorten, what he proposed in the last election against Scott Morrison, going back to the Hawke days, the Keating days, they were diametrically opposed when it comes to policies. Now it's very similar and, went through and looked at all the proposed legislation that the Libs have put forward in the last 1 or 2 years that hadn't been passed yet. And for over probably 2/3, maybe 3/4, they had bipartisan support. So, and certainly when they originally proposed the changes to the tax residency rules, Labor did come out and say, look, in principle, we agree it's time for a change. Whether they agree in principle to everything or whether they got their own slant on it. I mean, the big one for us right now is going to be what's their interpretation of the Board of Taxation's recommendations, and do they take them wholly on face value? Does my letter to Santa last year asking for 60 or 90 days instead of 45, does that help? There's going to be a lot of things. I mean, to me, when you look at what Labor's been like in the past for expats, generally it hasn't been too offensive, to tell you the truth. They've been more conciliatory towards expats. So it may not be necessarily a bad thing. I mean, I think there's an article today in the Sydney Morning Herald. Pretty much they've got some freedom of information documents from Marissa Payne, who's the foreign minister. And I think people were pretty happy to see her go, because she was one of the architects of the cap in terms of passenger caps, and how even George Brandis, who's the High Commissioner in London, said, you cannot do this, this will hurt expats. And she went against his recommendations anyway. So to me, if Labor's smart, they will pick up on that narrative that Scott Morrison, Josh Frydenberg with his changes to MRE, Marissa Payne with the border rules, they weren't very expat friendly. If Labor's smart, they'll try and rebuild that relationship and try and work on that. So I don't necessarily think it's a bad thing that Labor got in with respect to expats. The big question is there's probably three big pieces of legislation in the loop. And you touched on the first one, tax residency. And we're just going to have to wait to see what their adoption of it is. I mean, obviously the Libs would have done a lot of work on that leading up to the election. So if anyone's going to get it through quicker, it would have been the Liberal Party. It depends if Labor wants to go back and rebuild what the Libs were proposing. So really, it may have bought another 6 to 12 months. Who knows? We're just going to have to wait and see what comes out of it. I did see an article referring to the Labor Party going to do a mini budget, I think later this year. And normally the government does an update. I think it's the second half of the year, and they got to try and do their own version of their budget, which normally comes out of May, in actually later this year. So we might actually get a bit more clarity what they propose in that release.
Yeah, well, I mean, when you probably look at that release, I mean, they've already come out saying there's not too much that they're going to stray from their sort of budget reply, I guess you could say, just because of, when you look at the economy right now, inflation's high, so they don't want to throw excess cash at the actual economy and, I suppose heighten that inflation further or cause even more inflationary pressures. So definitely have to be mindful of that. I think as part of these residency rules, which were proposed, and I guess we are in a holding pattern, 1 July is when they're meant to be put through. My concern is the factors. Satisfy the 45-day test, the 4 factors. They really need to flesh those out and give us clear guidance on what, is essentially covered under each factor. Because the Australian economic interests was a real big concern. The Australian accommodation one, that was interesting because you could have a timeshare in a hotel and that was counted as Australian accommodation. That was ridiculous. Yep. The economic interest, that was, a bank account that was having ties to a discretionary trust or a company, even potentially a super fund, savings as well. So if they really need to give us firm guidance on that. And the other one was treaty interaction. They had a provision in there.
Tiebreaker.
That's right. Relying on the tiebreaker test. Again, all a recommendation, but we need to see the explanatory bill, which might get carved up a little bit from Labor, but they might be a bit more accommodative. So we'll have to wait and see. And then one of the other sort of, I suppose, proposed changes that we're waiting on, again, in a holding pattern, is, I suppose, what they wanted to do with the SMSF rules, the self-managed super fund rules, and trying to be a bit more accommodative for expats, that temporary absence rule going from 2 years to 5 years.
And then you also got the active members test too, where non-residents could actually contribute to this SMSF, which right now is a big no-no.
That's right. And I'm wondering how many expats saw that update, a proposal, and gone, oh, cool, I'll start contributing to my SMSF, or they've just acted on it already, even though it hasn't been legislated. I reckon there'd be a few, to be honest, because surprisingly, there are still a lot of expats that maintain an SMSF, even though they're overseas for 2 years. And gosh, if that legislation doesn't get changed, those expats get caught out, they're going to be in for a huge penalty, huge tax penalty, 45, 47%. whatever it is when you factor in the Medicare levy as well. So very interesting to see when that all might get put through. And then, yeah, we'll see what, I guess, their updated budget looks like. I feel like it's September, October when it usually comes out.
It is the later part of the year. That's right.
Yep. So I guess when we look at Labor, I mean, generally, yeah, I think they've been accommodative. I think if they were smart, they'd know and realise how many Aussie expats are overseas that still vote. So it would make sense to try and maybe keep that portion or percentage, small percentage happy. I wonder if they'd ever wind back any of the legislative changes that have been introduced.
I wouldn't put it past them because they are politicians at the end of the day. But as I said, if they're smart, they will, and I hate using this word, but they'll lean into, the negativity towards Canberra by expats, and they will pick up a lot of people in terms of those swing voters. And look, a lot of people I've spoken to in the last week, diehard Liberal supporters who did vote not for Libs.
I fell into that category.
I mean, I'm not the electoral roll, but I'm sure I'd be, just given the apathy that we were treated with, just purely from a Scottish expat's point of view, it was just, there's a phrase I was going to use, but I don't think we could say it online. But to me, they didn't care.
I agree. I've never done so much research about my local electorate and federal leading into a vote before. And shit, it was hard. I mean, you're right, though. There's so much greyness about which way that party's moving. And it's funny, people making predictions over the next sort of 20, 30 years that Liberals will eventually just fall away and it'll just be Labor and then potentially the Greens and then an independent. So it's going to be very interesting to see what happens over the next sort of 20, 30 years with all the parties. But I guess going back, Labor, all in all, they've been pretty accommodative towards Australian expats in the past. Be interested to see what their budget update is later in the year, see if they've looked at sneaking anything in or changing anything. They always like to have a play with taxes and other things, but at the moment, they're not really playing with taxes. I think one of the big wins was for not necessarily expats, but when it came to retirement strategies, this downsizer contribution that you could sell your former main residence or your main residence and move a large portion into super, that they're still going ahead with that proposal, which was from the Liberal side, reducing the age down to 55. So that's meant to be legislated now and apply as of 1 July 2022. That can still benefit expats when they come back to Australia, not necessarily while they're overseas though. So that's beneficial for retirement planning. So they're not really removing that. But outside of that, not too much was hitting expats yet. I think we'll have to wait and see what comes through over the coming months with, residency updates, the SMSF rules, and then what their budget update is to see if they've snuck anything new in there. We're really still in a holding pattern, unfortunately, for the next couple of months.
Well, yeah, and I think that the chances of any retrospective enabling of that legislation is pretty much gone now.
Agree.
New government, new everything. So I think it has bought expats a bit of time. When you look out to 2023, going forward, watch this space. It's going to be a really emotive thing. I mean, this piece of legislation hasn't been touched since 1936, so it's a big deal. And the cards will fall where they fall. Where they fall. Where they come out.
Yeah, absolutely, mate. Now, I wanted to segue into some Q&A because we've got a few good questions here about, firstly, the main residence in Australia, mainly talking about the main residence exemption at first, just the changes. So,
and thanks to Chad for jumping on the form. So sending that question in, and I'll encourage everyone who's got those burning questions. There's a link below in the show notes where you can click on that and fill in your details and have your question answered on the show. And we would love, every session to have a Q&A at the end. So the more questions we get, guys and girls, keep them coming in.
I'll admit, Brett, we've covered so many topics over the years. I'd be surprised if there's not too much we haven't talked about. But I think, as we know, every year it updates. Every year legislation updates, financial years change, contribution caps change, strategies change. Throw it out to us, guys, if you have any questions, because, I mean, we do this for you. Now, questions around the main residence. So I'll read it out. So my questions revolves around the 6-year rule for expats with the main residence. What are some of the issues that arise with regards to expats with ambitions to be abroad for 10 plus years? Question. And then he goes on to say, is continuing to rent it out past the 6-year mark going to be tax inefficient in the long run? So good question. As we know, a rehash of the main residence exemption, you buy a main residence, you move into it, you live there for a period, it's established as your main residence, you can move out of it and then rent it out for up to 6 years without it accruing any capital gains tax, assuming you have not bought another main residence in Australia. Now, with expats, they removed that main residence exemption, which applied 30th of June 2020. And that means if you sell the main residence after that date, right now, you will pay a very large amount in tax, assuming it's gone up in value since you've held it. It's a ridiculous rule because it means the period that you've lived in it doesn't carry that tax-free exemption at all. Now, I guess inefficiencies. So he's talking about, yeah, okay, if I'm renting out for more than 6 years, is that going to be tax efficient in the long run? Tough question, isn't it?
Look, it is. And to me, I think what people are probably not aware of is regardless of how long you're away from, you can bookend that period of time in that property. You know, if what Chad's saying, say he goes away for 10 years, but then if he moves back into that property at that 10-year mark, he's still entitled to the 6 years. It just means for a portion of it, for the 4 years or 40%, you know, he's not going to be entitled to it. So it's still an effective tool. You know, to me, it really comes back to suitability. You know, if you're away for 10 years, your life does quite often change. And we know a lot of clients who leave the country as a single or as a couple, you know, and then that main residence might be a 1-bedroom apartment. And then they go away for 10 years and they come back with a tribe. The ability for them to move back in that 1-bedroom apartment with 3 kids is a bit of a stretch. And I've had that conversation with clients before and they're like, you want it, let's do what? It is the truth. So if you can suck it up for that 6 to 12 month period, you know, it does make sense. Depends on the gains. Once again, you know, the property hasn't moved much, then you haven't got much of a problem to worry about. You can use a concessional contribution to, you know, extinguish that. So to me, everyone's different in that scenario. You know, to me, what Chad's saying about is continue to rent it out past the 6-year mark and be tax inefficient. There's 2 answers there. You know, you know, if you've got someone paying down the debt, that's good. Obviously, negative, passive, neutral, positive cash flow, that will dictate whether it's tax efficient or tax inefficient. People often try to pay down debt, not necessarily the best idea with respect to tax, because they'll start paying 32.5% tax on any positive cash flow. You know, it then goes on to talk about leaving the place vacant. At the moment, that's not an issue. Under the current rules, you get MRE indefinitely if the place is vacant. However, under the new rules, if the place is vacant, then you fail the accommodation test, the factor test, because you have access to that property. So in a 10-year time frame, yeah, there's a lot of legislative change there. So I think whatever you do, you need to have that flexibility in mind to cope with regulatory change. It really comes back to everyone's different. I mean, there is no Excel spreadsheet that gives you the answer. It really comes back to time in the market, you know, your motive or your attachment to that property. Some people, it's just a transaction. Other people, it's where their kids were born, so they want to keep it and all that sort of stuff. It really comes back to, I mean, you know, certainly holding it, there's no issues with that at all. But to me, the question I always ask people when they're about to leave Australia is, do you have an intention to return that property in one point? And people would say, properties in Brisbane, I never want to live in Brisbane again. It's like, well, then you got a problem, because if you want to bookend the tax in that property, you need to move back into that property when you come back, if you come back. So if you don't come back, then you've got a bigger problem.
That's right. And absolutely. And I mean, his last sort of comment was, you know, should one maximize their redraw facility to ensure that interest payment deductions are as high as possible? So essentially keeping the offset account or redraw empty, because that means you're always going to have, you know, the largest amount of debt on the property rather than paying it off. which means
I think this is good, actually. Great little point. And I'm not sure whether he's used the wrong phraseology, but do you want to I'll get you to run through with the folks out there the tax difference between a redraw and an offset, because this is a huge thing.
Well, I mean, you mentioned tax, but it also depends on the scenario that plays out with their situation when they come back and those sort of things. But redraw, so there is a big difference between a redraw facility and an offset account, and they do get confused and sometimes referred to as the same thing, but they're definitely not. So we'll start with an offset account because it's probably the easiest to understand. An offset account is a completely separate bank account. It's a non-interest bearing account, so you don't receive any interest on there. It is tied to the mortgage, but it is separate. For every dollar that you put in, you're reducing the principal amount in which interest is charged. Your mortgage repayments don't actually change though. They stay the same, but your end of financial year interest expense, which you can claim, reduces. So you are reducing your tax deduction for the interest expense that you're claiming on that interest on that property. So that's part one. Part two of the offset account, you can always pull the funds out, use it for whatever you want. And that means the tax deductibility of that interest expense going back up, you can still claim because it's tied to the property. That's great. That's really good. So an offset actually usually wins out, to be honest, against a redraw facility, but I'll talk about a redraw facility soon. An offset would be more advantageous for an expat that might be returning a repat, in the means that you've put money into an offset account, say in the last 12 or 18 months, because you know you're coming back. Yes, it's wound up the interest, it's wound down the interest expense tax deduction. That's probably not been as tax efficient as it could have been, to be honest. But it means when you get back, you can pull the funds out of the offset account and use it for, say, a main residence purchase. Because the offset account is linked to the old property, you can claim the interest expense based on that offset account being drained. So the interest expense will go back up and you can claim that as a tax deduction still, because you're not moving back into that property, you're buying a new main residence. It gets a bit confusing. The other account is a redraw. So again, redraw versus offset. A redraw facility is actually the loan itself. It's essentially being ahead on your mortgage repayments. That's probably the easiest way to represent it. And then sometimes clients or individuals, they'll have a windfall and they'll just put more onto their mortgage, into the redraw facility. Now, that's interesting. So a redraw facility, it's paying down technically the principal. So naturally your interest expense will go down as well, similar to an offset account with when it comes to that. However, if you wanted to pull out the funds out of a redraw facility and you're using them for a non-income producing investment or asset, that tax deduction associated with that interest expense going back up, you actually can't claim, unfortunately. So that's one of the disadvantages of a redraw facility, whereas an offset, you can put money in, you can take money out, doesn't matter. Interest expense will go up and down, but you can still claim it as a tax deduction as part of it being linked to that investment. However, a redraw facility, if you're pulling money out of it and you're using the money in the redraw to buy a main residence, well, it's, you're using it not for an investment at all. You're not using it for an income producing asset. Therefore, you're unable to claim the tax deduction associated with that interest expense going back up. So it's important to know whether you have an offset account or just a redraw facility, because they are very different, unfortunately. And it might mean that, with interest rates going up over the next 12 to 18 months, if you are refinancing or reviewing your mortgages, then that should be a consideration. Does the new mortgage have the ability to have an offset account, or is it just a redraw facility? If it has the option to have an offset account, that's great. It's a useful tool, and it's something that should be sort of added to your arsenal, to be honest. So that's definitely something to consider when you're looking at putting additional funds down on the mortgage, if that's relevant. Tax efficiency, as we know, more you put into the offset account or redraw facility reduces the interest expense, which can then lead into your property being positively geared, which then actually leads you to paying 1/3 tax on that net income. So it's a funny situation that pays out there. So probably holding it at slightly negative or neutral is actually going to be optimal. And then, your surplus cash flow is used towards other investments, other options, other buckets as part of your sort of wealth plan. So going back, should one maximize their redraw facility to ensure their interest repayment deductions are as high as possible? Question mark. Well, I think it's not a straightforward answer. It depends. It depends on sort of your situation, your goals around that. Holding it at neutral isn't a terrible decision. If you're going to be using the cash for a different investment, which is going to yield more than what you're saving in interest as well, or, I guess when you look at shares and over, say, a 5-year period, franked dividends are still 3.5% to 5%. That's still more than what you're going to be getting, say, on an interest rate right now, or the savings. So, when you work that out, maybe putting in shares might be a better option. But again, depends on your individual circumstances, what you're trying to achieve. So that's it's a tough one. It's not an easy, straightforward answer, but that's sort of diving into it a bit more for Chad there.
Look, and I think you hit the nail on the head, and if he is using the correct phraseology and redraw instead of offset, it pretty much answers the question. By maximising the redraw, it won't ensure interest payments deductions are high as possible. He can redraw his money out, but his interest deductions will be exactly the same.
That's right. Yeah. So it's a tough one. It's a good question though, and it's something that probably needs to dive a bit deeper. Chad needs to really probably think about what he wants to achieve over the next couple of years to really support those tax efficient goals. But mate, that's probably been a really good episode today. I think I'll wrap it up there.
Wrap it up there. So the world's not coming to an end, which I think what all expats want to hear. Labor's in. It's not the end of the world. The sun still rises in the east and sets in the west, but I think we'll get more of a narrative out of Labor and their ambitions and their proposals in the coming 6 months. Obviously, if anything happens between now and that briefing later this year, we'll certainly let everyone know. The big thing for us is it's a moving goalpost, and watch this space. Just a bit of housekeeping. Don't forget, you can put your questions that can be answered on the podcast in the link below. We've also got a number of things coming up 30 June. Folks out there, don't forget, it's like, we sort of liken this to people handing in assignments at school and university. When it's due at 5 p.m. on a Friday afternoon, don't hand it at 4:59 p.m. on a Friday afternoon. We are just over 30 days away from the end of 30 June. So now is the time to do a bit of housekeeping when it comes to looking at concessional contributions to offset positive cash flow, prepaying interest, all those things. If you haven't never done a depreciation allowance, look at that. There's a lot of things you can do to maximise your time, and certainly you can go, can't be bothered. Look, it's real money out of your pocket. So sort of time invested is smart, because we're talking about either reducing or extinguishing some tax debt. Absolutely, well worth it. So, and also thanks for the folks out there leaving us reviews. Keep it up, guys, because they really do help. It just helps us get the noise and the voice and the information out there to everyone who's an Australian expat, and we just want to keep that going and make it as loud as possible, and just make sure everyone's fully informed and can make smart decisions. Absolutely, mate. Appreciate your time today, Brett. Mate, good to catch up as always. Speak soon. Cheers, mate. Thanks, mate. Bye. See ya.